Hi everyone, thank you for joining our presentation tonight. I have 5:32 on my clock, so let's get started with tonight's San Diego real estate and economic update. It's an unusual rainy and stormy day today, so hopefully you're indoors and we can cover some real estate and economic data in the next 60 minutes. We have a lot to go through today. We're going to talk about a lot of things from interest rates to what's happening with the consumer price index, inflation, to what's going on in the San Diego real estate market. And there is a very interesting thing that happened in the last 30 days in the San Diego real estate market, which we will cover at the beginning of tonight's presentation. As I typed into the chat, if you have any questions this evening about anything that we cover, or any questions about anything we don't cover about economics or real estate, feel free to type it into the chat and I will answer all questions at the end of tonight's presentation. Additionally, if you have questions after today, I typed into the chat as well my email address, and you may reach out to me at email at any time. And one last thing, I will post this on YouTube, so you can rewatch tonight's video or share it with your friends and family as much as you would like. It'll be on YouTube within the next 24 to 48 hours. So real quick, an introduction of myself. My name is Patrick Kappel. I'm the team leader of the Kappel Realty Group here in San Diego. We are the #1 team at the #1 brokerage based on the number of transactional sales per year. We sell a house or an investment property in San Diego on average about every 3 days. So selling a home every 3 days in San Diego, my team and I, we know what's going on in the market. We have a very good pulse of what's happening in San Diego real estate. You can see my experience up there on the left. I have a little over 15 years of real estate experience in the San Diego market. I'm not just a consumer like you, buying and selling homes, or at least an employee. I'm also a consumer. I buy and sell real estate. My wife and I own 8 properties. A lot of those I bought all throughout my 20s and my 30s. I always say the sooner you can start buying real estate, the better off you'll be. I'm a board member for numerous boards. Specifically, you can see there, I'm a board member of the Southern California Rental Housing Association, also the San Diego Creative Investment Association, and UCLA Anderson Alumni Association. My team and I, we have sold well over $500 million in San Diego real estate in just the last 5 years, and that includes over 750 units. As I mentioned before, everything from first-time home buyers to investors that are getting into real estate here. I served in the Navy proudly, 24 years in the US Navy, and I recently retired just about 6 months ago from the Navy Reserves. I did a little bit of active duty and some Navy Reserve time. My education, you see there in the center, I have a Master's of Science in Real Estate, so I know real estate really well, inside out. Before that Master's of Science in Real Estate, I went up to UCLA, where I earned an MBA with a focus in finance and real estate. And my bachelor's degree is from the U.S. Naval Academy. The awards, you see them on the right, our team, as I mentioned already, Kappel Realty, top 1% in the nation. And also, as you see on the screen here, #1 team at the #1 brokerage. I'm very proud of the team that we have, specifically because although we work in real estate sales, we really lead by real estate education. And we help every single client that we work with. Many of you on this webinar tonight, I know, are clients, and the rest of you are probably future clients, but we really lead by education. So when someone works with any of our agents at the Kappel Realty Group, you can rest assured that you're going to be educated before, during, and after the transaction so that you make a fully informed decision. You can also rest assured everyone on our team owns real estate. You certainly want to work with a real estate agent that owns real estate so that they can understand where you're coming from when you're going through what can sometimes be a little bit of an intimidating experience buying real estate. And trust me, if it's your first home or your 10th home, it's always a little nervous buying real estate. I get nervous when I buy real estate because it's just a big life decision. We're here to help you with that life decision. And last slide before we get into the economics and the update on real estate. If you want to check out any of our other real estate educational videos, there's no better place to see them than on our YouTube channel. If you scan the QR code, I'll keep it here for a few seconds. You can scan the QR code. That'll take you directly to our YouTube channel. I recommend you follow it. We're always posting new videos. And along with real estate market updates, you can see other educational 60-minute clips, things like House Hacking 101, how to live in San Diego for free, how to invest in 2 to 4 units. There's even one titled How to Cash Flow $100,000 per year tax-free. So I definitely recommend you check out that YouTube channel. As I mentioned earlier, if you want to reach out to me after tonight's presentation, the best way is email. That's in the top right corner of your screen, patrick.kappel@compass.com. We're here to help you. We're here to help you navigate the San Diego real estate market. So with that, one last reminder, any questions, type them in the chat, and I will answer all questions at the end of tonight's presentation. So let's get started. I always like to start with this quote that a lot of people say, there's no such thing as a crystal ball. You can't see the future. And while I do not have a time machine, I do say we kind of can look into the future. There is a bit of a crystal ball, and it's called data and analytics. So when I present and when I work with clients, when my team works with clients, we like to share with you a lot of data. So tonight's presentation is going to be a little bit data intensive. I hope you're okay with that. But it's because, words can lie, but numbers tell the truth. So I like to share with numbers. Some major takeaways that I hope you absorb tonight and walk away with. Number one, real estate prices will likely escalate this year. And you're going to see why. And you're going to see specifically why I have this sentence up here at the beginning of tonight's presentation. Why do I think real estate prices will escalate and go up this year? Number two, the price of just about everything in America is going to go up this year. We've started some trade wars. We got a lot of tariffs that just have been put in place. And there's no exception 100% of the time. If you look back at history with tariffs and trade wars, we see prices go up. Number two, interest rates will likely go down slightly, not a lot. If they go down just very slightly, or remain steady. Right now, we're in the mid to high sixes. And depending on what happens economically in the United States over the course of the next 6 to 12 months, if inflation takes off, as it's starting to again already, we could see interest rates stay relatively high. Fourth, last but not least, if you're going to buy now. Why do I say that? Even with interest rates maybe staying high, even with them maybe even going up more, goes back to number one. We're likely going to see home prices continue to escalate for a myriad of reasons. One of them, we just lost over 10,000 homes in Southern California with the Los Angeles fires. Number two, we have not built enough homes in Southern California over the last decade. And number three, we have the largest generation, Gen Z, now getting into their 20s, and the second largest generation, millennials, well into their 30s, first-time home buying age. So we have this perfect storm of the largest generations in American history hitting first-time home buying age, intersecting with the decade of the least amount of home building to have ever have happened in the United States and SoCal. So we just have a lack of inventory relative to demand. And that's why we're seeing home prices up. And that's why I'm telling my clients, my family, even myself, if you're going to buy real estate, buy now. And to put it into perspective, in the last month, 1/4 of the real estate agents on my team submitted offers to buy property in San Diego in just the last month. In fact, last month in January, my wife and I submitted an offer to buy another property in San Diego. And as a guy with a master's degree in real estate, I am going to buy property right before I think it's about to escalate a lot in prices. That's how you can make money. So why do I think prices are going to go up a lot this year? Well, let's look at some of the data. Now, you've probably heard of the term canary in a coal mine. If you haven't, let me explain. Canary in a coal mine, way back in the day. We don't do this anymore, but back in the olden days, I guess you would say, coal miners would want to make sure there's enough oxygen in the coal mine so they don't die. So they would have a canary down there with them in a cage, and if the canary passed out and died, they knew the oxygen levels were getting low and they would run out to go to get some fresh air. The canary in a coal mine was the indicator of something changing or something happening. Well, there was an indicator, a canary in the coal mine, that happened in this last month from December to January. What was that indicator? Well, every year, home prices usually bottom out around December and January. Home prices go up during the spring, they kind of level out during the summer, and then home prices usually start going down in the fall, and they bottom out around December, January. That's a national phenomena, that's a California phenomena, that's a San Diego phenomena, happens with real estate because most people are buying homes in the spring and in the summer. Well, I always look at what happens from December to January because usually December to January, prices continue to go down a little bit because not many people are buying homes during the new year, during the holidays. And if prices go up December to January, they usually go up very, very slightly. However, there's been a couple of times when home prices have gone up a lot, month over month, December to January. And something happened this last month, January 2025, that not only was unique, but has never happened before in recorded history and has received very little attention. So let me share it with you. We got 17 people on here. You'll probably be the only 17 people in San Diego that know about this. Let's look back at history. 2022. In 2022, December, now specifically December of 2021, we saw the median home price in San Diego was $850,000. Fast forward just 30 days to January, and real estate values popped up to $880,000. That might not seem like a lot, but $30,000 increase amounted to a 3.53% increase month over month. Now, mind you, in the United States of America, real estate values usually only go up about 2 or 3% a year. But from 2021 to 2022, in that 30-day period from December to January, we saw prices go up 3.53% during a time that is usually kind of quiet in real estate. So what happened in the next 90 days? From January to April, prices went up to $1 million. That reflects a 13.6% increase in the next 90 days. We saw that back in 2022. Now let's go a little bit more further, but still back in history. Let's look at 2024. So in December of 2023, the median home price in San Diego was just over $942,000. Fast forward 30 days, 1 month, and in January 2024, prices went up $976,000. That reflects a 3.56% increase, pretty close to 2022. Still very notable because, again, usually January, home prices don't go up that much. When we go December to January, home prices usually go down a little, maybe up just a little, but rarely do they go up more than 2%. And these are the only 2 years in San Diego history when we saw home prices go up over 3% month over month from December to January. Well, what happened, do you think, the next 90 days in 2024 from February through April? The same thing. We saw April prices hit 1.09, a San Diego record high, and this was April of 2024, just last year, and that represented an 11.65% increase in 90 days. So what are we getting at here? Whenever you see price increases that are significant month over month from December to January, you better believe it that you're going to see some massive price escalation during that coming spring. So where are we at today? Let's take a look at 2025. At the end of last year, December of 2024, Christmas, the median home price in San Diego, just this last December, 2 months ago, was $1 million. Fast forward to just last month, January, median in price, 1.048. Now again, most years, home prices do not go up December to January, certainly not this much. What does this represent? A 4.86% increase. Folks, this is a big deal. We have never ever in San Diego history. I looked back all the way to when record keeping began. We have never had prices go up 4.86% December to January. Never. The record high was 2024, last year, when we saw prices go up 3.56. This is a huge increase for any month over month, let alone it happening from December to January. So, what's going to happen in the next 90 days? You're probably on this webinar because you care what's going to happen in real estate. Maybe you're a buyer, maybe you're a seller, and you're wondering, should I wait to buy? Should I buy right now? Will I even be able to buy? Are prices going down? Well, let me tell you this. If history is any teacher, and you and I both know history is one of the best teachers you can have, if home prices have gone up at a record high this last December to January, and let's say they don't even go up 13.6% like we saw in 2022. Let's say they just go up 20, like 2024 increases as we saw, 11.65. Well, if home prices go up 11.65% in the next 90 days, like they did in 2024, where's the median home price going to be? 1.170. Is that going to happen? Again, nobody has a crystal ball, but we have data and we have history, and all we have to do is analyze it to come to an idea of what is likely going to happen. So what is likely going to happen over the next few months or the next 90 days? We are likely going to see some massive price appreciation. It might be a little bit less, it might be a little bit more than the 11.65, but it is almost certainly going to happen. Now, maybe you're sitting there right now thinking, well, I don't want to buy a house right now. I want to wait a few months. If you wait just 90 days and prices go up 11.65%, as history has taught us, you will pay $122,000 more on that same house. Would you rather buy the house today for over $100,000 less, or wait 90 days? A lot can change in 90 days. We know that. And pay over $100,000 more. And that is if you're buying the median home price at $1 million. Now, if you're buying a $2 million house, well, double that number. You could end up paying a $244,000, almost $250,000 more. If you're shopping around $2 million and you want to pay $250,000 more, wait 90 days. Otherwise, buy now. Additionally, maybe you're at a lower price point. You're a first-time home buyer. You're shopping for a condo. Most condos in San Diego, $500,000, $600,000, but still an 11% increase of $600,000. You're going to pay $66,000 more for that same condo if you wait. So what am I telling all my clients right now? Well, I can't tell my buyer and seller the same thing, because here's how you know you should not trust a specific real estate agent. Now, I'm not calling names, but if a real estate agent tells you that it's a good time to buy and it's a good time to sell, that can't be true. It can't be a good time to buy and a good time to sell. That's like saying it's nighttime and daytime all at the same time. Not possible. It's either a good time to buy or it's a good time to sell. I'm telling my clients, if you're a buyer, buy right now. Buy right now before prices go up even further. If you are a seller, wait maybe 2 or 3 months. If you're a seller, wait 2 or 3 months, let a lot more price appreciation happen, and then go to the market and sell your home. That's what I'm telling my clients, and that's what most of my clients are doing right now. So let's take a look back at the last 12 months of the median home sales price. What you can see in front of you is a median sales price for both detached homes and condos. Now, the detached homes are in blue and the condos are in red. I want you to focus on the bottom of your screen. And you can see the graph, how it kind of goes up at a slant. The blue line, the price of detached homes, the red, the median price of attached. So condos and townhomes. And you can see that if you go back all the way to 2012, it goes up and then down a little, up and then down a little, up and then down a little, and it repeats. And this is the seasonal cycle that we often talk about in real estate. Real estate values usually go up a lot in the spring, a little bit in the summer, and then down in the fall and down in the winter. But they usually go up in the spring more than what they go down in the winter. You can see last year, 2024, in February, median sales price was 1.015, and you're looking at the top right now. And then prices kept going up through March, through April. They peaked out in May, and then they started going down in June, July, August, September. Now, same thing, if you look at condos, like I said, the median price of a condo is in the 600s, and you saw that condos peaked out in the summer around July, August, and then started going down and bottomed out in December. Usually prices, as I mentioned, bottom out December, January, making that the best time to buy. But mark my word, you will likely see a lot of appreciation in the next 90 to 120 days. Percent of original list price. So what is this that we're looking at? This is the sales price of a property relative to the price it was listed for sale. And as you can see, homes in San Diego usually sell between 95 to 105% of list price. This is not one of those marketplaces where you can buy homes for like 80% of what the list price is. They usually sell relatively close to the list price. And now, of course, that depends on how did the agent list the home. Now, most agents that have been in the business for a while, they know that to get the highest sales price, you got to get the most amount of offers. And to get the most amount of offers, you usually list a home right below its value. And that usually brings in a bunch of offers. You get a bidding war and you can sell it at market value, if not higher. But sometimes there's those homes that are overpriced and they sit for a month or two or three. Next thing you know, they're selling for well below list price and usually well below market value because they were priced too high. So for all my sellers, I always try to teach them, if you want to sell quick and more importantly, if you want to sell your property for what it's worth, if not more than it's worth, you price it right below its value. And that usually gets multiple offers, bidding wars, people get emotional, and it sells for more than it's even worth. That's the advice I always give to sellers. Sometimes I give buyers the advice, hey, look for a property that's been on the market for 2 months, it's overpriced, it's been sitting too long, and you might be able to get a discount on that one, but not on something that's new to the market. So why are home prices going up so much, even in this higher interest rate environment we're in, high sixes? Why are prices going up so much? This chart tells you the whole story. There's just not a lot of homes for sale. And I mentioned during the first few minutes of tonight's presentation that over the last 10 to 15 years, we just have not built enough homes. In fact, our population is like 10 times greater than what it was in the 60s and 70s, but we're building less than half the number of homes that we used to build in the 60s and 70s. We're just not building enough homes because it's expensive to build homes. We've run out of land to build on. And think about it, in San Diego, we're very unique in San Diego in that A, it's expensive to build, but B, think about the geography. To the north, we have Camp Pendleton. You're not building there. To the east, we have the Cleveland National Forest. You can't build there. To the south, we have Mexico, and to the west, you have the Pacific Ocean. We have nowhere else to build out to. So the only way to add housing inventory is infill, tearing down a house to build a duplex. For this reason and many others, we just don't have many homes for sale in San Diego, and that is not going to change anytime soon. So what is the forecast, not just for San Diego, but for all of California this year, 2025? Well, the California Association of Realtors put out within the last month or two the forecast, and it's expected, as you can see circled in red on the right, expected to have more home sales than last year. In fact, we're expected to have a little over 300,000 home sales. Last year was 275. That represents about a 10.5% increase in the number of home sales. The big one though, look at the median price on the bottom. It's expected that in California, on average, home values will go up 4.6%. Usually and that's an average for the entire state. Usually in San Diego, home prices go up more and faster than what they do throughout the rest of the states for the reasons I specified earlier. We just don't have enough inventory, and it's not easy to add inventory in San Diego. So this all goes down to what you learned in high school economics: supply and demand, the most powerful force when it comes to the price of anything. And we simply do not have enough supply relative to our demand, especially our rising demand. Believe it or not, lots of people are still moving into San Diego. Even with some folks moving out of San Diego because they can't afford it, there's more people moving into San Diego, specifically those that can afford it. But let's talk about the LA fires, which was a tragedy. Tragedy for LA, tragedy for our country, certainly a tragedy for the state. Because you see in the article here, experts say the destruction of the Los Angeles fires is likely to worsen Southern California's housing crisis. Over 10,000 homes burned in Los Angeles. Over 12,000 structures burned in Los Angeles in the last month. I want to put that into context. In the county of San Diego, in the entire county of San Diego, we sell 14,000 detached homes a year, plus or minus about 14,000. In Los Angeles, over 10,000 homes burned in about a week. So almost a year's inventory got wiped out in 1 week. And you and I both know that a lot of those Los Angeles homeowners, even if they want to stay in LA, they can't go back to their home. Many of them are going to move out of LA. And one of the top destinations that they're coming to, I can tell you firsthand because we have clients coming down from LA, is San Diego. That is only going to exacerbate the lack of housing in San Diego, and it's going to cause prices to go up even further because guess what? San Diego is pretty cheap compared to the area where these homes burned down up in LA. We have a huge crisis with the lack of housing, and it just got worse with those fires that occurred. Now let's take a moment to talk about interest rates. Seems like interest rates are a little bit of the tail that's wagging the dog right now. Well, this is one of the people, probably the primary person, in charge of what's happening with interest rates right now. This is Jerome Powell, chairman of the Federal Reserve, and they set short-term interest rates. Now, short-term interest rates do not directly affect the 30-year mortgage, but they do indirectly affect the 30-year mortgage. Now, is Jerome Powell and the Federal Reserve going to lower rates? Are they going to increase rates, or are they going to keep them steady? What are they going to do? Well, they're asking themselves that same question. And they have two goals in life. The Federal Reserve, Jerome Powell, they have two goals. Number one, they want to keep inflation around 2%. And you might be thinking, why do they want inflation around 2%? Isn't inflation a bad thing? No, inflation is a good thing, but too much of a good thing is a bad thing. They want to keep inflation at 2%, no more, no less. Why would they want inflation? Well, think about this. If you could buy a car today for $30,000, or you could buy a car next year for $25,000 less, why would you buy it today? You'll wait till next year. So you're not going to spend money. And that's called deflation. When we have deflation, the economy stops. This is why the Federal Reserve and the US government wants a little bit of inflation so that people spend money because prices go up, but they don't want too much inflation, 2%. They also want unemployment around 4%, just over 4. And you might think, why do they want unemployment? Isn't that bad? You want a little bit of unemployment. Otherwise, if everyone has a job, jobs are easy to get, then all of a sudden you're going to have too much inflation. So their dual mandate, keep inflation around 2, unemployment around 4. You might have seen the reading that just came out today. You can see the article here, timestamp February 12th. Inflation is on the rise. Consumer prices in January rose 0.5%, higher than expected. And right now, CPI inflation, consumer price index, same thing, inflation, is at 3%. And I just showed you we want it to be around 2. So with inflation going up, what is the Federal Reserve going to do? They're probably not going to lower interest rates in the next couple of months. Maybe later this year, but not right now. What's that going to do to mortgage rates? Doesn't mean mortgage rates are going to go wildly up or down, but it means they might remain kind of steady where they're at between 6.5 to 7, maybe even the low 7s for the next few months. Why is inflation going on right now? There's a lot of unknowns, but as I mentioned, we entered a little bit of a trade war with some of our major trading partners. And also the trade war has been coupled with tariffs. Whenever we have tariffs, and I think I read in the news just the other day, 25% tariff on steel, 25% tariff on aluminum. So many products use steel and aluminum. So this is going to cause many products to go up in costs, as much as 25%, if not more, maybe a little bit less, but you're definitely going to see some inflation coming down in the form of those tariffs. Also, we just have less trade going on. When you have less trade, you have more inflation because now you're no longer getting things built and created and manufactured the cheapest way. You might even be getting them made the most expensive way. What's going to happen to our interest rates? As I mentioned, I doubt we're going to hit 8. I also doubt we're going to go below 6. They're probably going to stay kind of where they are, as you can see in the chart in front of you, in the high 6s. In the fall of last year, late summer, really around August, September, we had rates get all the way down to the low 6s, but they just couldn't pass that threshold. Once we get down in the low 6s, a lot of people came out and started buying homes. Home activity built up. Home activity really starts to build up when rates get in the 5s. When that happens, we can expect home prices to go up a lot. But as you saw at the beginning with the canary in the coal mine analogy, we are seeing home prices go up at a rapid pace, even with high interest rates. Back to the reason why we just don't have much supply. We don't have much supply relative to the demand. And I mentioned earlier that the 30-year mortgage isn't directly tied to what the Treasury does. It's indirectly tied. What it is directly tied to, though, is the 10-year Treasury. So what we like to do in the mortgage markets, in the real estate markets, is watch what's happening to the 10-year Treasury, because when that goes down, 30-year mortgages go down. When that goes up, 30-year mortgages go up. Why is that? There's reasons beyond. We're not going to do a 60-minute conversation on Treasury yields, but there's a correlation because of the way mortgage-backed securities are traded on Wall Street relative to the 10-year Treasury, and investors kind of look at them similarly with a bit of a spread. And you can see the spread between here. 30-year mortgages, most of them are going to be bought and sold within 10 years. Most homeowners don't hold a mortgage for the full 30 years. They usually refinance it or sell a home before that might happen. But as I mentioned earlier, even with high mortgage rates, real estate values are still hitting record highs. What you're looking at now is two charts overlapped on top of each other. The top chart is that 30-year mortgage, okay, 30-year mortgage rates. And then the bottom chart is San Diego home prices. And I like to share this one because you can see all the way back to 2020 on both of these, the low interest rates on the top and a little bit lower value of home prices in San Diego County. But even with high interest rates going up, home prices hit record highs. So as it says at the bottom of the slide in front of you, when mortgage rates go down, home prices will go up even higher. If we're hitting record high property values in San Diego County with 6 to 7% interest rates, imagine what's going to happen to property values and the cost to buy a home when rates get back down into the 5s or even the 4s. You're going to see prices go up a lot. As I mentioned earlier, though, this year, rates will likely remain steady, or if they fall slowly but surely. And over the next 1 to 3 years, we will almost certainly see rates slowly but surely go down unless inflation starts to take off. We saw it peak up a little bit in January. We'll see what happens with the trade wars and everything and tariffs. That's going to cause some inflation. Hopefully it doesn't get out of hand. Just recently, I attended the UCLA economic forecast, and UCLA put out their forecast for what's likely to happen with the 10-year Treasury. And remember, that's important because a 30-year mortgage follows a 10-year Treasury. And as you can see, the 10-year Treasury might even rise a little bit at the beginning of this year, peaking out in the fall, Q3, and then start going down again. Why is UCLA predicting the 10-year Treasury and thus mortgage rates to maybe even go up a little bit? Trade war, tariffs, inflation. That's what it comes down to. But then start declining through 2026. Hence why the previous slide said probably going to remain kind of steady on mortgages, but over the next 3 years, we'll see them slowly go down. UCLA is also predicting that inflation will be higher for a little bit longer. Tariffs will boost inflation, and so far, UCLA is right on the money. Last December, inflation was around 2.7, 2.8. And coming into January now, it's ticked up to 3%. UCLA put out this prediction back in December. And here we are, January inflation just came out right on the money, 3%. Along with the tariffs and along with the trade wars causing inflation, deportations can also very likely cause inflation. Again, a lot of stuff has been made in Mexico, made in China, made overseas because it's cheaper to make it there, cheap labor. And when things are cheap to make, they can be sold more cheaply. We had some cheap labor in America. A lot of immigrants came in, worked for a little bit less than what many Americans would want to work with. But with immigrants being deported, that can also lead to some inflation, as you see in the bottom right of your screen, and also labor shortages. So all this ties in a little bit to the 30-year mortgage. But again, with the long view, likely by the end of this year, and certainly over the next 3 years, we will see interest rates go down. And based on historical trends, when interest rates get into the sixes, the real estate market, buyer demand gets really good. When it gets into the fives, it starts to become strong. You want to make sure that you buy your next house before buyer demand gets good and definitely before it gets strong. Why is that? Because as buyer demand picks up, that means you're going to face more competition. It also means that you're going to pay more for that house with stronger buyer demand. Now, sure, if you buy a house today, your interest rate might be in the high sixes. However, especially first-time home buyers, this is important for you to know. You can always refinance your interest rate. You can't do that with credit cards. You got a credit card with a 20% interest rate. It would be awesome if you could refinance a credit card to a lower rate. You could do that with houses. So if you buy a house and your interest rate is 7%, and 6 months later, rates are 6.5%, you can refinance to that 6.5%. And then a year later, interest rates are 6%. You can refinance it again to the 6%. 2 years later, interest rates are 5%. You can refinance to the 5%. You can always refinance your interest rate lower and lower and lower as time goes on, but you can never change your purchase price. And this is why I always implore my clients to buy now before prices go up even further, because you can't change that price. So why are they going up in San Diego specifically, besides we haven't built enough? Why is Southern California housing outperforming the rest of the US? And yes, you read that correctly. Southern California real estate markets are outperforming the rest of the country. Comes up to pent-up demand from years and years of lack of supply, good high-paying jobs. Southern California, Los Angeles, Orange County, San Diego, we have some of the best and the highest paying jobs in America. We also have a lot of international buyers coming back in. And as you see at the bottom, people simply want to live here. I have been around the world multiple times in my military career. I've been to 24 countries and I've been to all 50 states. And I can tell you, in my humble opinion, there is nowhere better to live than San Diego, especially when it comes to the climate and the laid-back atmosphere that we get to enjoy here. It is 12 months of eternal summer in San Diego. Now, San Diego ranks up here with the cities that you see on the left: Austin, Houston, Los Angeles, Orange County, Phoenix, Riverside, San Bernardino, and San Diego. As far as employment growth, these are all very high employment growth cities. Yet, although we rank just as high, if not higher, in fact, you can see Los Angeles and San Diego have higher employment growth than these other cities in Texas and Arizona. Yet with all this employment growth, look at the next chart. We are not building enough homes. In Houston, they're building a ton of homes. In Phoenix, they're building a lot of homes. In Austin, they're building a lot of homes. Keep on going down the slide. Look who's not building that many homes. San Diego and Orange County. In fact, amongst all of these major markets that have a lot of job growth, San Diego and Orange County have the least amount of new homes being built. That is only causing our housing crisis to become worse. That's a good thing if you already own a house, because that means you're becoming very wealthy as prices keep going up. It's a good thing if you buy a house now and get on the bandwagon before it comes too late. It's a bad thing if you wait and wait and wait until you no longer can afford a home because they go up in value too much. For this reason, the lack of housing, the strong growth in high paying jobs, for this reason, John Burns, which is the #1 real estate consulting firm in the United States, ranked Orange County and San Diego as the only two markets in the entire country ranked as strong. Now, this is their last year's data, March 2024. We're getting close to March 2025, so we'll look forward to see what the new data is, but it's likely not going to be much changed because we haven't added a lot of housing. We still have a lot of people moving into San Diego, and it's very likely that next year, Orange County and San Diego could possibly be two of the strongest real estate markets as well. Again, this is good if you own real estate. This is good if you're about to buy real estate because you know you're not going to lose value. Where would I personally not buy real estate? Anything that is orange, maybe even some of those that are yellow, because those are the real estate markets that are kind of weak. If you buy a house, it might be worth less next year than the price you bought it for. And you don't want the value of your largest asset going down. Where would I buy though? Anywhere that's green, definitely anywhere that's dark green. And as I mentioned at the beginning of tonight's presentation, for all these reasons, my wife and I even submitted an offer to buy another investment property just last month because we see now is a very opportunistic time to get into more real estate in the San Diego market. So let's get a little bit deeper into some of the broader economics affecting housing right now. I mentioned already we have all these high-paying jobs. Many of the high-paying jobs are in tech and biotech and healthcare. You see some of the healthcare developments going on right now, like in Hillcrest, UCSD is building a brand new $1 billion hospital. You see the huge growth down in South Bay, the Chula Vista Bayfront development, also a billion plus project going on right now. Seaport Village has a $2.1 billion project that is on the front burner that's going to get kicked off soon. And we also just built a lot of office space downtown. Also, Mission Valley is being completely turned over to what's being called the Innovation District. In partnership with SDSU, we're building a lot of apartments there and a lot of commercial space and lab space for all the biotech and just general tech coming into San Diego. With that, you can see why. Because in 2015 through 2020, San Diego was always kind of sleepy, but boom, 2019, 2020 into 21, we saw venture capital money just start pouring into San Diego like there's no tomorrow. And amongst all growing venture capital biotech cities, San Diego ranked #1 during that 3-year period of VC money flowing in. And it's no surprise that with that money flowing in, also during the pandemic years, 2019 to 20, San Diego ranked #1 as growth cities for tech jobs. The percent of tech talent job growth in San Diego was 38.6% during those pandemic years, higher than any other city in America. San Diego is ranked #1 in so many categories. Real estate and tech growth is just another one of them. So all these folks that moved here during the pandemic, 2019 to 22, they're not going anywhere because they love their jobs, they're making high 6 figures, and they're living in beautiful San Diego. And these are the people that have moved here, the tech folks that have helped increase the value of homes and limited the supply. Now, you might hear now and then about folks moving out of San Diego, and that is true, but they're being replaced by all these folks moving into San Diego. So again, John Burns ranking #1, Southern California, specifically Orange County and San Diego, is the strongest, best regional real estate market in the entirety of the United States. Now, I go to a lot of real estate investor meetups. In fact, I was at one last night, and I always meet these investors. Truth be told, and I don't say this offensively, but they just don't really understand real estate that well. They got a little bit of money, they want to spend it somewhere, and they go buy cheap real estate in Texas, Arizona, Midwest, They buy cheap real estate. They don't know that those are some of the lowest ranked real estate markets, and they have very high odds of losing their money or not making any money. Versus buying more expensive, yes, real estate in Southern California. But one thing I've learned in life, you get what you pay for. And when you get cheap, when you buy cheap, you get cheap back in return. I'm about to say I would put my money in SoCal. Truth is, I do put my money in SoCal because I understand real estate. I mentioned earlier population growth versus how many permits we are adding every year to new housing development in San Diego. You go back to the 1940s, and we had 520,000 people living in San Diego. Today, we have well over the 3.28 million, crossing 3.3 million now. Yet look at the number of permits we built. The blue lines, the blue bar graph, shows you how many homes we built in San Diego. Built a lot throughout the 70s, 80s, a little bit in the 90s, but since the Great Recession of 2007, 8, 9, we just have not built, barely broken 10,000 most years on the number of homes. We need to build 15 to 20,000 homes per year just to keep up with demand. Yet we have built less than 10,000 almost every year going back the last 15 years. We are simply not building enough. And if you look at the projections going out into the future to 2027, San Diego's continued to expect it to grow anywhere between 10 to 20,000 people per year, year over year. We just don't have the housing for these folks. And where are they moving from? Because I always like to say, it doesn't matter just how many people move in and out. It matters who moves in and out if you want to know what's going to happen to real estate values. And you can see in the chart in front of you, looking on your left, in blue, these are the areas people are moving from when they move to San Diego. So people are moving to San Diego from Los Angeles, San Francisco, San Jose, Boston, Orange County, and New York. These are some of our top feeder markets of folks moving in here. Are those cheap markets? Not at all. San Jose, San Francisco, Orange County, New York, you and I both know those are some of the most expensive cities in America. So when those folks move here with their tech jobs, they see $1 million for a house as super cheap. And they're bringing the sign-on bonuses and all that tech money to buy San Diego real estate. Where do people move when they leave San Diego? We can see down here, number one, Riverside, not too far. Then Phoenix, Las Vegas, Nashville, Houston, Dallas. They're moving to these cheaper areas because they can't afford San Diego anymore. So if you're asking yourself, how much more can San Diego home prices go up? The answer is a lot. And the reason the answer is a lot is because the people moving here are coming from areas where the average home price is $2 to $3 million. And they're buying a $1 million house in San Diego. So there's a lot more room for growth in San Diego. Now, when you look at this chart in front of you, it's kind of funny how it correlates to another chart. You can see the states where there's a lot more housing inventory than there was before the pandemic. You can see like Texas, you can see Arizona, you can see Nevada, you can see Florida, you can see Tennessee, all areas I would not recommend investing in because inventory is going up there and supply and demand determines the value of everything. And you're getting a lot more supply in those blue areas, a lot less supply in the states that are colored brown, like California, light brown, negative 14%. Is that a bad thing? Is that a good thing? It just means home prices are going to go up a lot because we don't have the inventory. So what do you expect nationwide for US home prices? Almost every single economist, almost every single publication that has come out in the last 2 months about 2025 real estate projections are positive, expecting home prices to go up. When you average many of these forecasts, comes out to 3.5%. But mind you, that's national. It's expected US home prices to go up 3.5% this year. When you zoom in specifically on San Diego, it's going to be much more than that because San Diego always appreciates more than the rest of the nation. And even Goldman Sachs knows that. This Goldman Sachs article came out in the last couple of months. And in it, you can see what I highlighted. The strongest home price growth is going to be in three main areas: Cleveland, Chicago. So kind of like your upper Midwest areas. Then you got the East Coast, New York, Boston. All these cities, guys, I'm not moving to because I don't like winter. I lived in North Dakota my whole childhood. I'm not going back to snow. If I want snow, I'll go to Big Bear for the weekend, but I'm going to the third area, San Diego. Because as you see, Goldman Sachs, people assume California would be the worst performing state because it's so unaffordable, but California is tough to buy, it's tough to build, tough to build. We have limited supply, and there's just no financial distress coming here. So there's a lot of folks moving into San Diego, but not a lot of supply, ensuring we're one of the top markets in the area. I mentioned national-wide phenomena as well. We had too much housing inventory in the early 2000s, and you can see that oversupply of both red and blue, the for rent and the for sale. And since the Great Recession, coming out of that Great Recession, we now have too little supply. The opposite problem. For those of you who are maybe my age, you lived through the Great Recession. I graduated college into the Great Recession, and we saw home prices go down because there was way too much supply. Right now, we're having the opposite problem because there's too little supply. We're seeing home prices skyrocket up. And look at that depth of supply, guys. We're just not going to dig ourselves out of this. Too little supply. Population growth, we already hit on, won't dive too much into it, but this one goes out a little bit further beyond 2027, goes to 2034. And you can see by 2034, we are expected to grow from the 3.3 or so million that we have today to almost 3.7 million. We're going to add another 300 to 350,000 people in our city in the next 10 years or so. That is a lot of growth. Now the next few slides, I want to ask you a question. And this is really breaking down the math. And this is important for those of you sitting on the fence thinking, should you buy a place? Well, let me ask you this question. If you could rent a place for $3,000 a month, or you could buy the exact same place, and now that you own it, you have to pay $39.90 a month, almost $1,000 more. What would you do? Now, most people would say, well, I'm going to rent it because renting is cheaper. And a lot of articles that you read, podcasts you listen to, family members and friends that you listen to. By the way, here's some advice. Don't take advice from your family member and friends unless they know real estate. Take advice from them about life or ethics or whatever else, but only take real estate advice from real estate professionals, just like you should only take medical advice from medical professionals. So here we are going to show you, not through advice, we're going to show you through numbers why owning it for almost $4,000 a month is cheaper than renting it for $3,000 a month. Let's peel back what I call the layers of math. Now, I'm not going to go through this complex spreadsheet that you see in front of you. Instead, we're going to zoom in on the top left portion of the spreadsheet, aptly named rent versus own. So let's take a look at it. Let's see what happens to Mr. Renter versus Mr. Owner. If you buy a condo for $500,000, and it exists, this example, we're using a downtown condo. $500,000 is a market value. And let's say you put down 5%, $25,000. Now you might be thinking you don't have $25,000. Don't worry about it. We can give you $25,000. And yes, you heard that right. If you're a first-time home buyer, we work with lenders that have loan programs that give our clients free money to buy their first home. In fact, in the last few days, one of our clients just bought a home and they were given $80,000 through a down payment assistance program to buy their first home. So let's say you use a down payment assistance program. You get that $25,000 for free to buy the $500,000 home. And let's say you get a 6.5% interest rate. You also have, as you see in the top right, taxes, insurance, HOA fees. Now, a couple of assumptions to make. Number one, let's assume that the value of the property goes up 6% a year. And that is, my friends, the 50-year average of real estate appreciation in San Diego. Let's also assume you could rent it today for $3,000 a month, which is pretty on par. I own this unit. I know what it rents for. And let's assume your rent goes up 5% a year. In San Diego, your rent can go up anywhere from 5 to 10% a year. Let's say it goes up 5. Well, what happens? Year one, you see on the far right, the owner is paying $39.90. The renter's paying $3,000. Now, most people stop doing math here. They just stop thinking. That's a mistake number one. Don't stop thinking here, because this only assumes you live for 1 year. We're going to assume that you're going to live for another 10, 20, maybe even 30 years, and I hope you do. So let's fast forward. Let's fast forward 30 years. Over a 30-year period, assuming the owner keeps paying their mortgage, they'll pay 1.597 in mortgage payments. The renter, assuming they keep on renting, they never buy a house. If their rent goes up just 5% a year, not 6, 7, just 5, the renter is going to pay 2.391 million over those 30 years. The renter is going to pay almost $800,000 more to rent instead of own. This is why I always say renting is way more expensive than owning over the long term. Now, next, monthly payment at year 31. Now it's been 30 years, you're old, you're ready to retire. How are you going to retire if you're a renter now paying $12,348 a month? You heard that right. That's how much you're now paying. You thought you were getting a good deal today paying $3,000, but $3,000 going up just 5% a year in 30 years, you're now paying $12,000 a month. Whereas if you're the owner, you've paid off your mortgage. Not only are you not paying $39.90, now you're just paying over $2,000 a month. And that's just your HOA, your taxes, and your insurance. But here's the big one, your net worth. If you rent, your net worth is still zero. You have no equity in the property, none. But if you own it and that condo goes up 6% per year, year over year for 30 years, which is the average rate of appreciation in San Diego, your condo is now worth $3 million. So the question is this, not would you rather pay $39.90 or $3,000? The question is, would you rather pay 1.597 to have a net worth of $3 million, or would you rather pay 2.391 million to have a net worth of zero? After looking at it that way, folks, the math gets real easy, and you can see very clearly it is far cheaper to rent than it is to own over time. And you might be thinking, well, I'm only living in San Diego for a year or two. All the better, because now you can buy that property, and when you move out of San Diego, keep it as an investment property, put a tenant in it, let the tenant pay down your mortgage, and in 30 years, when you're ready to retire, your pension is at $12,000 a month that a tenant is paying you. It's the magic of math, and it works. So San Diego cheap? I would say San Diego is some of the most undervalued real estate in the world. There's a difference between cheap and undervalued. Why do I say it's undervalued? Because look at the top 5 most expensive markets throughout San Diego, and you can see Los Angeles, the median income is $92,000, and the median home price is $896. Folks are spending over 77% of their income towards their house. San Francisco, median home is 1.5, median income 159, they're spending 76. You look at all these expensive markets, and again, folks are moving to San Diego from San Francisco, from San Jose. And you look at San Diego, 67.3% of income going to the median house. That's still a lot of money, but it's less than all these other cities. And with the median homes price, $905,000, this is from like just a couple of months ago, we are still cheaper relative to our income compared to other areas. Now, you might think, are people really spending 67% of their income towards housing? No, they're not. Because this is assuming everyone in San Diego buys a house. And I can tell you, most people in the bottom quarter, maybe even the bottom 50% of income, are not buying homes. It's those individuals making 80,000 and more, for the most part, that are buying homes. And folks making less are buying homes, but they're just doing it with friends, they're doing it with family, they're doing it with a spouse. So what should you do? Wait to buy, or buy and then wait? Well, I would say buy now and then wait and refinance your mortgage, because the escalation of prices is not just a San Diego phenomena, it's a national phenomena. When you take a step back and you look at US median home price appreciation throughout the United States, it is going up in every state, in every city, perhaps not as much as San Diego, but it is going up. There's just nowhere that is cheap to live today. And why is that? It's not due to something crazy. It's not because there's a crash. It's because we don't and have not built enough supply relative to our demand. Now, if you wait for rates to go down, I mentioned you're going to pay more money. And why is that? Well, think about it. People qualify based on how much they can afford on a monthly payment. Someone who today can afford a $4,000 a month payment at a 7% interest rate is buying a house for $750,000. And when interest rates go down, someone who, let's say they go to 4.5, that same 4,000 monthly payment now buys $1 million house. That doesn't mean when rates go down, all of a sudden you can buy a nicer house. That just means because sellers aren't that, sellers want their money and they want as much money as they can get, trust me. So that just means the seller who had a $750,000 house is now selling you that same house for $1 million. $1 million, the same house that was 750. So as you can see on the bottom, a 2.5% drop in mortgage rates, which can very likely happen over the next 3 years, can cause real estate values to go up another 33%. This is why I encourage you to buy now while real estate prices are relatively low compared to what they could be in the future. You might be thinking, well, Patrick, prices are high today compared to what they were 2 years ago or 3 years ago. Forget about that. 2 years, 3 years ago are gone. It's the past. You have to look at what are prices today compared to what they will likely be in the future. And prices today are relatively cheap compared to what they will be in the future. There's things you can do to help keep your price down. Things like 2-1 buy down programs, down payment grant programs, free money assistance that we can help give you. I alluded to those a little bit. And as you can see in front of you, owning beats renting if home prices rise by 3.5%. And this happens almost all the time. Over the last 10 years, in fact, the average rate of appreciation in San Diego was 8%. You come out ahead all the time. Home ownership definitely remains the number one goal for the American dream, even ahead of being able to retire as home ownership. And again, I'm like an old millennial, but right behind me, the Gen Zers, they almost all want to buy a house. Over 95% want to buy a house. That is a lot of demand. You can see behind Gen X, these millennials, these post-millennials, the Gen Zers, these are huge generations. And we have not built enough homes for these 127 million people, a third of our country. We have not built enough homes for them. And they are now aging into their 30s and into their 20s and in the first time home buying age. We have not built enough. So mark my word when I say this, home prices will continue to appreciate, strong appreciation over the next decade plus because of this huge level of demand intersecting with a lack of building over the last 10 years. And of course, these millennials and the Gen Zers, they want to buy a house, majority of them, almost 60, for emotional, lifestyle reasons, the pride of ownership. And then, of course, many of them want to buy for financial reasons because I showed you in the chart, it just makes sense. Now, I'm about to close it out, but I want to end it with a few last notes. Free down payment money. I already mentioned it. If you are a first-time home buyer, or if any of your friends, any of your family members, maybe your children are first-time home buyers, reach out to me for sure, because we can definitely help just about any first-time home buyer get free money through California and San Diego government grants that go towards your down payment. And I mention that because for Gen Z, younger folks, the number one concern they have with buying a home is not having enough down payment. We can get you that down payment for free. All you need is 5% down. You don't need 20. You don't need 25. Honestly, you don't even really need 5 because we can get you that money for free. A lot of folks, the number 2 reason, 20.8%, they don't know where to begin. Well, I'll tell you where to begin. It begins by just emailing me, reach out, Patrick Kappel, patrick.kappel@compass.com. Shoot me an email, a text message, anyway, carrier pigeon, reach out to me, and we will set up an initial consultation meeting. It's informal, it's easy. We usually do it on Zoom, and we learn more about you. We talk about your goals, and we give you a strategy and we help you execute that strategy, and we work for you to help you buy your first home. All these down payment assistance through the San Diego Housing Commission, California Housing Finance Agency. These are the programs we utilize to help first-time home buyers. If you're not a first-time home buyer, maybe you're buying your second or third home, maybe you're buying an investment property. We are a big team of 13 agents, and we are also the right team for that. Everyone on the team owns investment real estate. We, I think, are right now not just number one team in San Diego, but number one team in San Diego for also duplex, triplex, and fourplex purchases for folks that want to get into the investment game of real estate. In that down payment, we've helped our clients get over $1 million. Over the last couple of years, well over $1 million, we have helped our clients get access to go towards their down payment, their purchase. And I'm going to close it out now and go to Q&A, and I'll leave it with this quote. In order to cross the finish line, and for a lot of people, that finish line is owning a house, buying a property, maybe having an investment. In order to cross that finish line, though, you must first cross the starting line. And what does the starting line look like? Well, it looks like a meeting with myself and my team, who you see in front of you. And I put the tagline on the bottom there, who you work with matters. And I say it because I mean it. Many of you watching this video right now, I'm assuming you probably don't work in real estate. I didn't work in real estate for like 10 to 20 years when I was in the Navy. When I was in the Navy, sailing around the world, serving in the military, I didn't work in real estate. And I assumed all real estate agents are the same. And I assumed like, wow, they must get overpaid or something because it doesn't seem like they do a lot. And here's the truth. Now that I've gotten out of the Navy, and now that I've worked in real estate for a decade plus or so, I have learned, just like all professions, not all doctors are the same, not all lawyers are the same, not all teachers are the same. You got your good ones, you got your bad ones, you got your mediocre ones. Our team, we're not just good, we are the best. And I know that because I'm extremely picky about who I allow into the team to ensure that they have the knowledge and the communication skills to educate and teach and assist every client I work with. If you want to work with the best of the best, we are truly the number one team at the number one brokerage, and we'd be happy to assist you. Again, the best way to reach out to me is that email. You see it in the top right, patrick.kappel@compass.com. And you can also check out these YouTube videos. I'm going to leave it here while I answer some of the questions that it looks like maybe came up in the Q&A. But scan that QR code and you're going to see a lot more information on educational videos that I recommend you check out. Also, follow us on Instagram, Facebook, along with fun photos now then of me and what I'm doing. You'll also see some data and trends that are going on in San Diego. So I got a couple of questions. I'll answer them right now before I jump off. Someone asked, could I comment on how home price value for condos compared to single family? Okay, let me start with this. I always tell people the best property to buy between condo and house is the one you can afford. If all you can afford right now is a condo, better to buy a condo than to buy nothing. My wife and I own a number of properties in San Diego. The first two properties I bought were condos because it's all I could afford. I couldn't afford a house at the time when I was in my 20s. Those two condos, ironically, I still own and I rent them out. I preface it with that, but what do I think about appreciation? Home price value. The question is, what do I think of home price value for condos compared to homes? I'm guessing the question is, what do I think of appreciation? In general, single family detached homes will likely appreciate more than condos over the long term for this one reason. What we're building in San Diego today is primarily condos. We're building a ton of condos. We're building a ton of townhomes. And let me be clear, we're actually not building a ton. We're not building enough. But what we are building, even though it's not enough, is condos and townhomes. And we are not building too many single family homes. In fact, we are tearing down single family homes. And on the lot where the single family home was, we're putting in like 4 condos because we're doing what's called infill. Every big city, like New York City, Boston, Chicago, those cities used to be just a bunch of little houses. And then one day they tore down the houses and put up small apartments. And then one day they tore down the small apartments and put up high rises. That's how cities get built. San Diego is a relatively young city to those I just mentioned on the East Coast and the Midwest. So in general, single family homes appreciate a little bit more, but condos are still going to appreciate. I will tell you this, a condo in San Diego is likely going to appreciate more than a single family home in just about any other state or city. A condo in San Diego will likely appreciate more than a house in Texas, a house in the Midwest, a house in Nevada, Arizona. Condos in San Diego appreciate more because of San Diego appreciates more. Hope that answers your question. Next question, what percentage of home property tax is passed on to renters and tenants? All of it. I mean, most landlords, and I know this because I'm a landlord, if my property cost me $2,000 a month between my mortgage, my insurance, my taxes, my maintenance, if my property cost me $2,000 a month, am I going to want to rent it for $1,500? No. I mean, if that's all I can get on market rent, that's what I'll do for the first few years. As you might know, like a lot of San Diego real estate appreciates so much, but might cash flow negative for the first couple of years. But soon enough, rents go up in San Diego faster than almost anywhere in the nation. So you buy a property, you're going to be cash flow positive within a few years, and you're going to be raking in the money within 10 years, if not less. But yeah, I can tell you if for most landlords, if all of a sudden San Diego said, hey, landlords, your taxes are going up on your property, the landlord's going to pass that on to the tenant all day long. Just like look at it in the supermarket. I mean, Waffle House. Waffle House said eggs are expensive, so now we're going to charge consumers more to eat eggs with their waffles. Oh, and by the way, the eggs are expensive, guys, not because of inflation. Like inflation is making everything a little bit more expensive. Eggs are expensive because of the bird flu. Millions and millions and millions of birds have died. And that's why eggs are expensive, because of death, not inflation. Inflation in the last year has only been like 10% or less, not what eggs have gone up. Anyway, weird analogy. Short answer is 100%. If property taxes go up, rents go up. That's just the way it is. Another question. Oh, not a question, just saying thank you. Ah, that's so nice. One of my past clients is saying, thank you for helping me purchase my home 2 years ago. I'm so glad to hear that because any of my clients that bought homes 2 years ago, 3 years ago, 4 years ago, they're happy because they bought before prices went up even further. And I implore you, if you don't own a home, any of you out there listening might not own a home, buy a home now before prices go up even further. I don't have a crystal ball, guys, but I do have data and I make my own personal decisions off the data. And I am only sharing with you the advice that I take myself, the same advice that I give my team. And as I mentioned at the beginning, a third of my team, a quarter of my team submitted offers to buy real estate in just the last few months because we see the canary in the coal mine and we see real estate values are likely going to escalate a lot in the coming months. With that, I will end it. It looks like that is all of our questions for today. I think I answered them all. Thank you all for joining tonight. Be safe, be kind to one another, and call me, reach out to me, email me when you need some real estate assistance. We're here to help you and everyone else in San Diego. Thank you for joining and have a good night.